As of the last trading session on Friday, May 15, 2026, the U.S. equity markets are closed, and Nokia stock, trading under the ticker NOK on the New York Stock Exchange, finished the day at $14.48 per share. This represents a minor intraday decline of 23 cents, or 1.56% down from its previous close, pulling back slightly after reaching a 52-week high of $15.19 earlier in the week. While the broader retail investing crowd still associates this company with the indestructible plastic bricks of the late 90s, the institutional desks pulling the strings on Wall Street are tracking a completely different narrative. The immediate massive insight that the general market hasn't fully digested is Nokia's aggressive expansion into autonomous network management systems and its fresh executive poaching from industrial heavyweights like Siemens. Just days ago, Nokia quietly launched a suite of software tools built on operational insights from over 600 million broadband lines globally, directly targeting the integration of autonomous software assistants into physical fiber and telecom infrastructure. This isn't about selling routers or 5G antennas anymore. It is an aggressive land grab to control the software layer that orchestrates global communications. This pivot toward intelligent, self-healing systems is causing major ripples across popular investing sites as sophisticated institutional traders reevaluate Nokia's enterprise value. The standard expectation surrounding Nokia stock has long been defined by stagnation. For years, individual brokerage accounts loaded up on this name hoping for a simple cyclical turn in telecommunications infrastructure spending. The consensus was that Nokia would remain a slow-growth utility provider, perpetually squeezed by hyperscalers and trapped under a low valuation ceiling. The reality, however, is completely upending that assumption. Under the leadership of Chief Executive Justin Hotard, the firm has initiated a radical structural overhaul. By bringing in enterprise leaders like Emma Falk to spearhead their mobile infrastructure wing, they are signaling that their future relies on software-led architecture, open interfaces, and deeply integrated intelligence, rather than just shifting heavy hardware. This sudden shift from a basic hardware supplier to a high-margin system coordinator is forcing retail platforms from the traditional Fidelity trading platform to the agile Robinhood app to witness massive surges in daily trading volumes for Nokia. When you look closely at the recent stock movement, the numbers tell an incredible story of accumulation. Nokia stock has delivered a stunning performance over the past year, rocketing from its 52-week low of roughly $4 all the way to its current mid-teen consolidation zone. This massive move didn't happen in a vacuum. It has been driven by heavy institutional accumulation and intense options market activity, which you can easily track if you monitor the data feeds via Interactive Brokers trading. Volume profiles show that major funds are quietly rotating capital out of hyperinflated mega-cap tech and parking it in enterprise telecom infrastructure that provides a stable cushion against broader macroeconomic pressures. While retail traders are obsessively checking day-to-day fluctuations in Nvidia stock, Apple stock, or Tesla stock, the smart capital is hunting for mispriced infrastructure assets. This rotation has triggered sustained accumulation patterns across major platforms, keeping Nokia's trading volume well above its historical baselines, as the market realizes the company is consistently beating its quarterly cash flow targets. To put this structural shift into perspective, we have to look at how different brokerages are positioning themselves. Investors managing their own funds through self-investing setups or utilizing premium guidance like Schwab Intelligent Portfolios are looking at asset allocation in a brand new light. When seeking online investment assistance to maximize yield while keeping risk metrics balanced, finding a stock with a strong underlying balance sheet that trades at a reasonable price-to-earnings ratio is rare. Nokia's recent financials reveal a surprisingly clean balance sheet, boasting billions in operating cash flow and a steady dividend program that was updated just last month. This combination of structural growth and income protection is exactly why investors who utilize an intelligent portfolio approach are allocating space to this legacy name. It offers a defensive moat that standard tech high-flyers simply cannot replicate when the market faces liquidity crutches or sticky inflation data. Let us step back for a moment and examine the core operations of this business model to understand how they generate these numbers. Nokia operates through distinct segments: mobile networks, network infrastructure, cloud and network services, and their highly profitable patent licensing arm, Nokia Technologies. For years, the company sat in the shadow of its past failures in the consumer mobile handset space, but the business model today is purely focused on business-to-business infrastructure. They build the underlying routing systems, optical networks, and fixed wireless systems that keep the global economy online. Their older financial reports often reflected the brutal capital expenditure cycles of telecom carriers, which led to choppy earnings. However, by steadily shifting their revenue mix toward recurring software licenses, private wireless systems for industrial ports, and enterprise cloud solutions, they have stabilized their gross margins. It is this fundamental transition from volatile hardware sales to predictable software fees that is catching the attention of analysts who provide specialized investment help across the industry. This operational transformation is triggering intense debate across all major platforms. Comment below how many shares of Nokia stock you currently hold, or if you are planning to add it to your portfolio next week. I know to see how many of you are playing this infrastructure turnaround versus sticking purely to standard big tech names. Looking out into the near future, the battle between market expectations and raw reality will be won or lost on execution. The primary catalyst to watch over the next 2 quarters is how rapidly telecom operators adopt Nokia's new autonomous software systems to cut down their home broadband support costs.
If these operators can achieve the targeted 50% reduction in repeat technical home visits by using Nokia's autonomous tools, Nokia will secure long-term, high-margin software contracts that will cause Wall Street to aggressively re-rate the stock's valuation multiple. For anyone utilizing a Fidelity brokerage account or managing an individual brokerage portfolio on another platform, this execution matrix is the most vital metric to track. However, this outlook is not completely free of risk. The enterprise telecom sector remains highly sensitive to global supply chain adjustments and national security policies regarding communications infrastructure. If interest rates remain restrictive through the later half of the year, regional telecom carriers might slow down their optical network upgrades to protect their own cash balances. Furthermore, competing firms are fighting desperately for the exact same enterprise footprint. This means Nokia must continually innovate its software ecosystem to stay ahead of the curve. Investors tracking these developments through tools like Fidelity mutual funds or specialized Fidelity ETFs are keeping a close watch on these macro headwinds, balanced against the stock's strong defensive metrics. When you look across the entire modern investing landscape, the options for constructing a robust portfolio are vast. Whether you prefer online investing through an interactive broker's platform, navigating asset classes via the Robinhood app, or looking for premium advice through Fidelity Wealth Management, the key to outperforming the market always comes down to identifying gaps between public perception and actual corporate performance. For years, public perception labeled Nokia as an outdated, forgotten hardware company. The underlying reality is that it has quietly transformed into a highly efficient cash-generating infrastructure backbone that is steadily embedding advanced automation into the core of global communications. To wrap it all up, the core insight here is that Nokia stock is no longer a speculative play on cellular hardware cycles. The historic data and recent trading surges demonstrate that the market is finally beginning to price in its high-margin enterprise software transition and its strategic executive leadership adjustments. While the general public remains focused on the daily price swings of high-profile consumer names on their Robinhood stock trading screens, the institutional money has been steadily accumulating Nokia shares near its recent lows. As the company pushes deeper into industrial orchestration and autonomous network tools, the gap between what the average retail investor expects and what the business is actually delivering continues to widen. Keeping a disciplined eye on their upcoming quarterly earnings and software adoption rates will tell you exactly how high this infrastructure turnaround can run. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.